Hello everyone. In previous class, we are classified the financial assets on the basis of two criteria. One is a business model, another one is contractual cash flows characteristics. And on the basis of these two criteria, we are classified our financial assets as the debt instrument, equity instrument, and the derivative instrument. So for measurement of the financial asset, we have three options: amortized cost, and fair value through other comprehensive income, and fair value through profit and loss account. For each instrument, how to measure and how to treat is already completed in the previous class. In today's class, we will go for the recognition of the financial instruments. So in financial instruments, there are two types: financial assets and financial liabilities. In short, I have mentioned it as FA and FL. So here is the initial recognition. Recognize the financial asset and financial liability only when the entity party to the contractual provisions of the instrument. If the company is the contractual party for this particular contract, then only we should consider it as a financial asset or financial liability. So these all things we have already completed. This principle, what is there, we are going to apply for the following: receivables and the payables. So receivables and payables, if it is the contractual party only, then we are going to consider it. Then firm's commitment to purchase or the sell goods or services. So this one we should recognize only at the execution of the contract. So firm's commitment is nothing but the contract. We are going to execute that one only it is executed, then we are going to recognize it. Before execution of this particular contract, we should not treat it as the financial liability or the financial asset. Okay, so only at the execution we can decide it as a liability or the financial asset, correct? Fine. Then about the forward contracts, at the commitment date itself, we should consider or the recognize it as the financial asset or the financial liabilities. About the option contract, if it comes under the standard only, we should consider it here. And planned future transactions. So this is just a planned one. It is not it implemented. That's why we are not going to consider in financial assets or financial liabilities. On this basis, let's analyze. So here is the regular ways to purchase and sell the financial assets. Usually terms of contracts established at the beginning itself. So the contract terms are established at the beginning. The regular ways to purchase or the sell shall be recognized or be recognized as applicable using trade date accounting or the settlement date accounting. For accounting treatment, there are two options: trade date accounting, okay, when you are traded that date, or settlement date accounting, when the settlement is done that date accounting. Just a date is changed and even some of the amount will change, but the ultimate effect may be the same. Timing of the recognition is also depends on the same. So the timing of the recognition also depends on the trade date account and the settlement date account. Why? Because if you are preparing your accounts on the trade date and if you are preparing your accounts on the settlement date, the transactions and the entries may be bit different. Correct? So on the basis of that, we are going to recognize the financial asset or the financial liability. Trade date accounting. Financial assets purchased is recognized on trade date with the simultaneous recognition of the related liabilities. The financial assets purchased and the simultaneous liability, that is nothing but the payables, okay, is recognized on the trade date, okay, on the trade date. The financial assets sold is de-recognized on the trade date with the recognition of gain or loss. Here the recognition means we are going to write it in the balance sheet, and de-recognition means we are going to delete it from the balance sheet. Okay, so here purchase means yes, obviously it should be added to the balance sheet. Sale means it should be deleted from the balance sheet, correct? Then settlement date accounting, the only difference is we are going to write the entries in the settlement date. Okay, and the amount is also going to change little bit. The financial asset purchased is recognized on the settlement date with the simultaneous recognition of related liabilities. When you are purchasing, then you need to pay, right? So that payables also simultaneously recognized, and financial assets sold is de-recognized on the settlement date with the recognition of gain or loss on the sale and related receivables. If you are sold, the chances of gain or loss is also there, and even the receivables is also there, correct? You will get the amount that receivables also recognized. The main problem here is the fair value changes between the trade date and settlement date. The fair value is nothing but the present value, that is market value. So the date is changed, correct? The trade date and the settlement date will definitely differ, and the value in the market for that particular asset or the transaction will definitely differ. So this changes will be problem for that. So what is the difference? That also we need to identify. Let's understand it with the example. X Limited purchased the financial assets as on 29th March 2015 for 100 lakhs. On 31st March 2015, that is at the year end, and the 2nd April 2015, that's the settlement date, are 105 lakh and 103 lakh respectively. Accounting treatment of the transactions depends upon the classification of the financial assets. Pass the entry for the trade date accounting and settlement date accounting. So we need to pass the entries for the trade date accounting to and settlement date accounting to. Let's go for the entries. Here I have categorized the entries in three ways. Okay. So financial assets at amortized cost, financial asset at fair value through profit and loss account, financial asset at fair value through other comprehensive income. Okay. So here it is a purchase, that's why it is a asset. Fine. So on trade date accounting, the trade date is 29th. The financial asset account to payables account. In all three types of the treatments, the amount is same. There is no changes at all. At amortized cost, at fair value through profit and loss account, at fair value through other comprehensive income. So what is amortized cost? We will understand in next class. On 31st 3 2015, so what happened on 31st 3 2015? The value of the asset is changed, correct? It was 100 lakhs on 29th March 2015. On 31st March 2015 at the year end, that is became 105 lakh. So the entry is financial asset account to profit and loss account. Why profit and loss account is created? Credit all incomes and gains. So 100 was the value and it is increased to 105 lakh. The 5 is the profit for us. That's why the entry is financial asset account related to the profit and loss account. 5 is the profit here. At the fair value through profit and loss account only we are going to write it like this. But for other comprehensive income on the same date, the entry is bit different. Instead of a profit and loss account, we are going to take that profit through other comprehensive income. That is why financial asset debtor to the other comprehensive income account. So obviously at amortized cost, there is no entry at all. Fine. On second, what happened? The date second, the value is decreased from 105 lakh to it is decreased to 103 lakh. So this is what? This is loss for us. What is the loss? It is 2 lakhs. So debit all expenses and losses, correct? So that's why we are debited profit and loss account to the financial asset account, correct? So add the fair value through profit and loss account. Since we are treating it through profit and loss account, the entry is profit and loss account. So here is the loss of 2 lakh, correct? So here if we are treating it through other comprehensive income, we should debit the other comprehensive income and we should credit the financial asset account. Other comprehensive income account debtor to the financial account loss is 2 lakh. And at the end payable is, obviously it is 100 lakhs, correct? The payable accounts 100 lakhs at the amortized cost, at the fair value through profit and loss account, that is also 100 lakhs. Fair value through other comprehensive income is also 100 lakhs. So what is the profit for us right now? On 31st we got 5 lakh of profit and on 2nd we lost 2 lakh. So now our profit is 3 lakh rupees and 3 lakh rupees is ultimately transferred through profit and loss account, correct? So that 3 lakh is adjusted in the profit and loss and the payable is through 100 lakhs. Because why we are paying only 100 lakhs? Because we are purchased it for 100 lakhs only. Okay, so when we are entering into the contract, the value is 100 lakhs. Then after price of that asset is increased, so that is the profit for us. So if we are waiting till 2nd April, we should pay 3 lakhs more, but now we are already entered into the contract on 29th of March. That's why we need to pay only 100 lakhs. Fine. So let's see the difference in settlement account. So on 29/3/2015 there is no settlement, that's why there is no entry. Okay, this is the trade date, that's why there is no entry, because we are writing these accounts on the settlement date. On 31st/2015 there is a settlement fair value change account. There is a changes in the fair value, so that's why fair value change account refer to the profit and loss account. So let's compare here on the 31st/3. The entry is financial asset account to profit and loss account, but here we are going to write it in the fair value change account. Okay, to the profit and loss account. Here, if we are treating it in the other comprehensive account, then the entry is fair value change account to other comprehensive income account. Then on second, we should treat it like financial asset account to cash account. This is the entry at amortized cost 100 and 100. The entry for the fair value through profit and loss account and fair value through other comprehensive income is like this. So financial asset account is 103. Other comprehensive account is 2 lakhs, and to cash account how much we need to pay? It is 100, and to fair value changes account how much it is changed? 5. Am I right? So this is the entry. So if we are writing it in the fair value through profit and loss account, then the entry will be financial assets account 103, profit and loss account. We are treating it through profit and loss account, so that's why the financial asset account debtor to profit and loss account. What is the loss? That was 105 lakh, and it is decreased to 103 lakh. So 103 lakh financial account and 2 lakh is the loss. That's why it is debited. To cash account, how much we need to pay? 100, and the total fair value changes is 0.5. So this is what the entry under the settlement date account. If you compared both, there is no much differences, but you will get the difference in these two entries, and the only one entry difference is fair value changes account. Okay, and another is there is no entry in the trade day. Okay, so these differences will arrive, but the ultimate effect on the balance sheet will be same. Okay, see here financial account is 103 lakh. Okay, so that will comes under the financial asset. Here the financial asset account, what we are debited here is 100. Okay, just 100, but at fair value through profit and loss account it is 5. So that 5 is added to the financial asset account, then after that 2 is deducted from the financial asset account. Correct, those 2 is the loss. Here in this trade date account, once we are debited 100 lakhs for the financial asset, and then after what we have done, 5 lakhs once again we are debited, that is added 105 lakhs it became, and then we have created 2 lakhs, that is 103 lakhs. So in both the entries at the end in the balance sheet, the financial asset value will be 103 lakh. So ultimate effect will not change, but these entries will change. So this is what the difference between the settlement date account and the trade date accounting. Okay, so that's it for today's class. In next class, we are going to study about the measurement of financial instruments under that financial asset. So from today's class itself, we are going to study the practical aspects, journal entries and some of the calculations. Be ready for that. Keep your notes with you and pause the video and write it when I am explaining.